The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions bored of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, it was a rough day in corn, soybeans, and Chicago wheat on the back of good planting progress, especially for quarter beans. Spring wheat, KC wheat, we were able to limit the losses in many cases, or even find a little bit of green on the screen, but there is a lot to unpack here. Joining us today, we welcome in Jim McCormick with agmarket.net. Jim, always great to catch up with you, and I know for a lot of traders, a lot of folks today, not farmers, looking at this market, rough day on Tuesday. And I kind of had the feeling after we saw Monday afternoon's crop progress report that we were going to have a bit of a down day, just with that big uptick in planting progress, especially quarter beans over last week, Jim.
Well, yes, good afternoon for having me on. Thanks for having me on, Jesse. But yeah, you're right. We set the tone last night when the crop ratings came out at 3 o'clock Central Time. The reality is we made a lot of progress. We're just shy of 50% planted on the corn. The bean progress, we're putting beans in at the second highest pace ever. Now, it's not all perfect. I know you're listening. If you're listening to us right now, by chance, and you're in the Eastern Corn Belt, your parts of Indiana and Ohio, we are struggling to get into the fields. North Dakota specifically is still struggling, but the I-states, they are rolling fast and furious. The weather's not perfect, I would argue. I mean, we are going to warm up the next couple days across the Midwest. Then we got some big rains coming through. But if you look at the long range maps, I think this kind of accentuated the problem, Jesse. It wasn't just the number we got on Monday afternoon. It's looking out. The 6 to 10 day and the 8 to 14 day models are trending drier to much below normal rainfall for this time of year. Mm-hmm. Maybe a little bit cooler than normal bias, but a cooler, drier bias. The reality is, if trade took that, is we're going to get this crop planted relatively good place. I think maybe the only exception may be North Dakota. That area, my clients are saying it really is going to depend on how much rain falls this weekend. The GFS model this morning was kicking out 2-3 inch totals. If that would be the case, I think you would be hearing a little bit more prevent plant acreage coming into play. If it tends to be closer to 1 or less than an inch of rain, you're probably going to hear people back away from the prevent plant and get a little bit more acres in. So that, that's the one area we're looking at. But everyone else overall looks pretty good for the next couple of weeks to, get that final part of planting done.
Well, and just to piggyback off of that thought real quick, maybe the one bright spot we had on Tuesday was we did have a little bit of green on the screen in spring wheat with the planting delays across the northern plains. And then Kansas City wheat, we know that crop in Kansas and Oklahoma is not good. We got the Kansas wheat tour next week. It's probably going to confirm that crop is not good. So we found a little bit of support in those two markets on the grain side. On the back of some of those issues, it seemed like, Jim.
No doubt about it. You nailed it. The planting, like I said, we're not going to get all the corn in. We're probably not going to get all the wheat in. That's supporting to Minneapolis. Chicago, like you said, Chicago wheat was under pressure all day. The funds have been short Chicago wheat. They continue to pile into that short. And then they kind of spread that short off against the Kansas City wheat. I would be a little bit cautious getting too bold up on the Kansas City wheat going into this wheat tour next week. And the fact that we're now rallying back up to those highs we made last week, which is what, $1 plus off the lows. So some of that may be priced in, because then you look at the export market, which is part of the problem we're seeing in the pressure in the corn and the beans, is we're not competitively priced in the export market in those commodities. The fact is we're really not competitively priced in the wheat either at this point in time. So it's kind of the wheat market's going to be balancing a domestic versus international pricing.
Well, competitively priced, let's talk about this corn market. You mentioned the funds. They're going even shorter, it looks like, in this corn market a little bit. And we said it before we jumped on the air, just kind of an added kick on Tuesday was more corn cancellations from China. And it seems like the Chinese are looking and waiting to turn to that cheaper Brazilian corn potentially here. And I just think about all of the export concern, and I look ahead to the calendar here Friday with the May WASDE report. especially this corn market. I'm a little worried, Jim. I mean, I almost think USDA has to cut their corn export forecast on Friday. What's your thoughts about that and just the general tone in this corn market overall right now?
Well, on the export side, I think you definitely got to be a bit worried about it. China's now done 3 cancellations here in the last couple of weeks. It's totaling roughly 33 million bushels. I agree with you, Jesse. That all but sets up. I think the surprise would be they did not cut exports. I think the trade is going to look for 20, 25 million cut in exports, maybe a slight revision in ethanol demand. We'll see how that is. I think they're going to wait and see how the driving season goes on the ethanol side of the equation. But I do expect the exports to be cut 20, 25 million, and that will be tacked on to the ending stocks. The reality is we're just not competitively priced. I think Brazil's selling corn anywhere from $35 to $50 a metric ton cheaper than we are at this point in time. And, unless that crop really starts to deteriorate fast, we're going to continue to lose that business to the Chinese business away to South America, unfortunately.
Yeah, and I think that same story could be said in soybeans too, is with the Chinese, is that big Brazilian crop online. They're going there for cheaper beans, and it's just it feels like a rough picture. It feels like a very bearish picture heading into Friday's WASDE report, whether we're talking corn or beans, Jim.
There's no doubt about it. Exports in the beans are very, they're not near as delayed, lagging as the corn, but it is a concern. We haven't seen cancellations in the beans like we have the corn, but the fact is Brazil is selling beans a lot cheaper to the world market than we are. So you could see it happening. We are importing beans into the, you're probably going to see them raise the import of beans from Brazil into the U.S. on this report for old crops simply because of the price competitiveness. But that's only one part of the story. The other part of the story, obviously you mentioned, Jesse, is the new crop balance sheet. This will be the first official balance sheet of the new crop. Traditionally, they take the acreage number of folks that they gave us in March. They plug in trend line yields. On corn, you're looking at about a 1.88 and 1.5 trend line yield. And then the trade's guess is really to try to guess demand. Well, the average trade guess is looking for this carryout to be right around 2.1 billion bushels. A few traders are going higher than that because it really depends on where your demand's going to be. But either way you look at it, if you take the average trade guess for old crop and then what the average trade guess is for new crop, you're looking at the corn carryout growing by roughly 750 million bushels year on year. Anything over 2.1, 2.2. It's hard to get too bulled up about without a weather problem. And the same situation is for the beans. The bean carryout could easily creep over 300 million, and it's the same situation. That's a pretty big jump year on year, and that's also going to be very hard for the bulls to, grapple with unless we have a weather problem.
Well, Jim, thinking risk management as we watch a lot of this bearishness and watch the charts here, and I'll say this, and you can disagree with me on this, but I think in the case of old crop quarter beans, at this point, if a farmer's holding on to them, they're gambling with those bushels. I think at this point, whether they should be or not, that's probably the case. I think more of our focus now is on this new crop, and I look at new crop corn, D's corn, 5.18 at a quarter after the close Tuesday. Nove beans, 12.54 at a half. So I mean, risk management heading into a big report like this on Friday. What should I be thinking? What should I be doing? What would you say to that, Jim?
Right now, it's a very tough situation. The reality is producers aren't really thrilled about selling corn at these levels. If you're really worried about the report, I would encourage you to consider maybe looking at some short-dated puts. Maybe go out and buy like an August short-dated 520 put or something like that. Same thing for the beans, where you're buying a little bit of protection that'll put a floor under the market, maybe not buying as much time. That way, if we do get a bearish reaction and we continue to grind this market lower, you are at least putting somewhat of a floor in place, but it will allow the market, to participate if the market goes up. If you want to cheapen that option strategy, you might consider selling a call above the market. If you do that, that does open up the margin risk, Jesse, but it will lower the cost of that premium of the option up front. But that's just something you might consider. The reality is it is early May. Normally, as they say, we try to kill the market once or twice. There's a couple wild things that could happen, kind of black swan events. We're still waiting to see, will Putin shut down the grain corridor? Mm-hmm. A lot of people don't believe he will, because he's threatened to do it multiple times and he's yet to do it. I think there is a real probability he could, as this war is really intensified. On top of that, the Chinese have been buying a lot of Ukrainian corn. Well, now the Chinese can buy the Brazilian corn. So maybe he doesn't feel the political pressure from the Chinese to say, hey, don't shut down our essentially our provider of grain. So we'll see what that comes out. The other thing we're going to look at is just the weather situation. Dakotas are still fighting a little bit, but as well as South America, specifically on the corn. They are moving into the dry season relatively fast. There's not a lot of rain in the forecast. Now their crop is still just finishing up pollination in the fill stage. If the market would get a little bit nervous about the supply of the South American crop, that could provide us with a little bit of a relief rally. But if we would get that relief rally, be it tomorrow, be it on the report on Friday, or be it, going into Father's Day weekend, whatever it is, we are arguing, get the orders working to take advantage of that rally if it would come. Because if you look historically, when you get the relief rallies, they don't tend to go up and consolidate. They tend to go up. They're there for less than 24 hours, then it comes right back down again. So you need to figure out your break evens, where you're comfortable selling, and get the orders working.
We are having a conversation today with Jim McCormick of agmarket.net. Jim, one other thing over top of this entire commodity trade that I wanted to touch on with you and get your thoughts is, of course, the debt ceiling issues. We have this standoff in D.C. right now between the Republicans and the White House, whether or not they're going to raise the debt ceiling limit here. A lot of the warnings coming out that June 1st is this quote unquote deadline here to get this done. I know we're in unprecedented territory, but I feel like still in the backdrop of this entire commodity trade is this fear of the debt ceiling, the recession fears, et cetera, et cetera. What's your thoughts on that whole situation and how that's playing into this ag trade overall right now, Jim?
Well, right now, I think the one thing you got to keep in mind, Jesse, the debt ceiling beginning of June, there is not a hard date. Folks, reality is it's an estimated date where essentially they're doing special measures now where essentially they say, we've run out of all the money we've got. We're not bringing enough tax revenue in. My guess is we will get the deal done. Hopefully. I mean, there's a lot of people say it won't matter. I think a lot of smarter people, meaning economists, say that would be negative if you default on that loan. The reality is interest rates are already high. The Fed's raised it over 5% here in the last year, trying to fight inflation. It's like yourself. If you're a producer and you default on a loan, you don't make a land payment, you don't make a farm machinery payment, then you have bad credit rating. The next time you want to buy something, they're going to charge you more for the money because you're at a credit risk. That is what the United States is going to risk. We've already got a huge problem with too much debt. You compound higher interest rates because we defaulted on it. You're just essentially causing yourself your own pain. So my guess is they are going to get it done, but it's going to go down to the wire. It's unnerving to the market, Jesse. If you look at what the banking sector is doing, it's been under pressure, no doubt about it. The economy slows down. And if you look at the Commitment Traders Report, the index funds, they've pared their position down massively from where they were a year ago. Now, the index funds, for people to know, they're the ones that just buy and hold. Mm-hmm. They just buy ags, or they're buying ags commodity as a long-term investment. They have really gotten out of American agriculture. They think they're not a good long-term trade. And it's the same situation that's going on in the in the sector for the trading funds. They are right now paring back. They're actually short beans. They're short wheat. They're long beans. They're short wheat, and they're short corn. And it shows you there's just not an appetite for commodities. And that's a problem because we need that money to come in and want to buy, in essence, to drive the market up, because the end users don't want to bid up on corn. So the ones that push the market up tend to be the speculators. And the speculators right now are essentially, the way I look at it, they're just not interested in American agriculture at the moment.
Another piece of this puzzle in the outside trade is crude oil. And I made this observation the last couple of days, or last couple of times this has happened. When crude is broken lower the last couple of times or pushed higher, we continue to seem to gravitate back towards this $73, $75 handle in crude oil. And it's looking like that's what we're doing again here at the beginning of this week. What's your thoughts on just how crude's playing into everything right now, Jim?
I think it's in the middle. It's kind of trading a sideways range. The reality is the crude doesn't want to get too, every time it gets in your 80, it stalls out. Yeah. That is a function of worried about U.S. demand. The consumer right now has been overtly resilient. Probably, the jobs number last week was phenomenal. We continue to spend, and that's what makes the economy go. But if you look what's going on, numbers out of China, imports to China are down. So China's not getting that COVID rebound that the world had thought. So I think crude, anytime it gets up near 80, it stalls out. On the other hand, you get down to the below 70, in the mid 60s, You hear more and more talk about the Biden administration maybe stepping in to essentially start refilling the strategic oil reserve, which is probably a pragmatic thing to do, being the fact it is down low. And the fact of the matter is, if they did it, it'd be a heck of a trade. Selling crude over $90 to $100, buying it back at 65, it'd actually be doing a taxpayer a pretty good trade if you can pull it off. But it's only pulled off if you get it bought. If you don't get it bought, it's a problem. So that's a little bit of underlying support. The other thing, every time we get down below 70 into the 60s, the Saudis talk about cutting production as a way to drive the prices up. So in general, we're in a sideways range. I would argue getting the mid 60s as a long-term energy price, heating oil, down in the low twos, it's probably not a bad time to lay off risk, and try to get some of your energy needs covered, simply because, it seems like we're in a range, and that's lower into the range.
Well, Jim, let's look at livestock trade. It was a good day there on Tuesday, and I know we've had some of the recessionary fears and the economy fears weighing into this trade here as well as of late, but feels like cattle especially took advantage of cheaper feed prices as one area anyway of support, and we found some good strength in feeders leading the fat cattle higher again, and hogs even found a little bit of support as well. But overall, it just felt like livestock as a whole took advantage of weaker grain prices on Tuesday and gave us a little bit of positiveness, I think, to wrap up our day.
No doubt about it. I'm going to start with the hogs. They probably think had the best performance of the day. The reality is they started off weak, took out the lows, and then had made new lows for the move. Then had a nice reversal and closed above yesterday's highs. So you have an outside day up. That's technically a pretty good sign that maybe we've exhausted the downward push of the market, at least temporarily. Now, I know hogs, look to the cash market, futures look expensive, but, if you look at the price of pork compared to the price of beef at the grocery store, pork should start to garner some more of that share of that business. So hopefully that allows this hog market to bounce. Now, the cattle market had a great day today. The one thing about the cattle market is as long as the consumer is there to buy this cattle, the supplies are tight enough that it should keep this market steady to higher. The thing, if you're a cattle producer, you've got to be cautious about if the consumer loses faith, due to job cuts. We start seeing the unemployment start to go up, or more importantly, this debt ceiling actually breaches, and you see the stock market go down hard because of economic uncertainty. That will the one thing that's keeping the cattle market up, I should say, is just that demand. Mm-hmm. If the demand starts to falter, the cattle market will do just like the grains are doing. It's going to have to go down until it finds a place where the consumer is willing to step back up. But right now, today was a good day. Like I said, a good jobs number. The market's not panicking about the debt ceiling just yet. So hopefully we can keep that cattle market moving a little bit higher the next couple of days.
Well, and too, with this cattle trade, I know a few folks have mentioned this to me, and especially on a good rally day like we saw on Tuesday, a little follow through from Monday. If I'm a cattle guy, maybe getting a few hedges in place here, not a bad idea to protect some of that downside and protect some of that floor against some of those things you mentioned there, Jim.
I 100% think you nailed it, Jesse. I would encourage people to follow Jesse's recommendation. Get some protection under it. I mean, the reality is this. We have a lot of uncertainty in the market right now. You look at the bullish side of the equation, it's incredibly easy, to look at the supply side and go, wow, I'm bullish cattle. But a lot of people, when cattle were up at the recent highs, are like, cattle is going to 200. And then we had the banking crisis and the cattle market slid. Like I said, I do believe the debt ceiling will get done. I'm optimistic it will, but my guess is it is going to go to the deadline. And it's going to get very, very unnerving for people. And if the stock market would have one of those really drastic, hard down day, 1,000-point plus moves down, I think it will drag that cattle market lower. And God forbid we did, trip the debt ceiling. We've never done that. We've never defaulted on our debt. So we'd be in uncharted territory. So if, on these updates to buy some puts to lock in profitability, I think it's a pragmatic business decision to make.
Sometimes I say some things that make sense, Jim. Sometimes, not all the time, but sometimes. I appreciate you being on the show today. Before we let you go, any final thoughts or anything else you want to reiterate for folks here today?
My thought is going to be this. The markets have definitely been depressing. There's no doubt about it. These downward shifts the last couple of days. Last week, we had a nice little revival in the Korean markets a little bit. We gave back some of it today. But really, you need folks, Jesse, I'm going to encourage them, get your orders working, get those wishing orders working, 30, 50-cent rallies. I'm saying I think those are kind of the targets I would look to sell some grain. But you need to get the order working, because more than likely, if we do get that shift or pop up, however you want to describe it, it's not going to last. A lot of you guys are going to be in the fields more than likely the next couple of weeks trying to finish up the planning. You don't want to miss the opportunity if it does come. I mean, it may come on a headline of the Black Sea shutting down, so it may happen in the middle of the night for all we know. So get those orders working, because you never know what the market's going to do.
Well, if folks need some advice, Jim, I know they can reach out to you and the team there at agmarket.net and talk and get some advice very easily. How can they reach you, Jim?
They can reach into the Ag Market team members at 844-424-6758.
And also online, agmarket.net. Jim McCormick, appreciate the time. Thank you for joining us here today on Market Talk. Have a great one. We'll talk to you again soon.
All right. Thanks for having me on, Jesse.
And that is going to do it for today's program. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.